Conseco, a company that epitomized the rapid rise and dramatic fall of corporate America in the late 1990s and early 2000s, emerged as a financial giant with ambitious growth strategies and a unique approach to the insurance and financial services market. Founded in 1979 by Stephen Hilbert, the company started with a vision to provide financial security through innovative insurance products. By the 1990s, it had transformed into one of the largest providers of health insurance, life insurance, and annuities, boasting an impressive market capitalization. However, this meteoric rise was deeply intertwined with aggressive acquisition strategies and a penchant for financial engineering, which would ultimately plant the seeds of its catastrophic decline. The underlying strategy behind Conseco's success lay in its aggressive acquisitions during the insurance industry's consolidation phase. The company's aggressive posture allowed it to acquire numerous smaller firms, which helped expand its product offerings and customer base rapidly. The crowning achievement of this strategy was the acquisition of the insurance company Greentree Financial Corporation in 1998 for a staggering $6 billion. This move aimed to diversify Conseco's portfolio by entering the business of home equity loans, which was experiencing rapid growth at the time. However, the transaction proved to be disastrous as it increased the company's exposure to risk in a volatile market and obscured the weaknesses in its core operations, causing hidden liabilities to brew beneath the surface. Concealed from investors were the growing problems within Conseco's financials. Monitoring the company's performance closely, analysts began to express concerns about its accounting practices and the aggressive assumptions behind its valuation of assets and liabilities. The company adopted what is known as mark-to-market accounting, which allowed it to record expected future profits as current income, thereby inflating earnings. This practice was met with skepticism by analysts, who warned that it conflictingly prioritized short-term gains over long-term stability. As losses began to accumulate, it became clear that these early warning signs were a prelude to a brewing crisis. By 2000, the financial markets began to feel the tremors of Conseco's troubles. Financial analysts on Wall Street started downgrading the company's stock as stories of its unsustainable business model made headlines. The company faced mounting operational challenges, primarily stemming from the high interest rates affecting its fixed income investments. As interest rates rose, Conseco's ability to fulfill promises made in life insurance contracts began to falter, leading to significant liquidity challenges. The once celebrated giant now appeared increasingly vulnerable, and corporate America started to question the sustainability of its model. In December 2001, the storm finally broke. Facing overwhelming debts and significant liquidity problems, Conseco filed for Chapter 11 bankruptcy protection. This move shocked corporate America, triggering a re-evaluation of aggressive accounting practices and rapid expansion strategies across multiple sectors. The bankruptcy filing was one of the largest in U.S. history, with liabilities exceeding $61 billion. The magnitude of the collapse resonated not only within the insurance sector but also in a broader spectrum of corporate governance discussions and prompted calls for regulatory reforms aimed at improving financial transparency and accountability. As the dust began to settle in the aftermath of the bankruptcy, investigations unearthed numerous improprieties surrounding Conseco's accounting practices. The company's executives, including founder Stephen Hilbert, were scrutinized for their roles in the financial debacle, with some facing legal repercussions. Some analysts likened the Conseco case to a cautionary tale of hubris, where growth and expansion were prioritized over prudent financial management. The bankruptcy also highlighted the risks associated with aggressive acquisitions and financial mismanagement, sending a powerful message to both investors and corporate leaders about the importance of transparency and sustainable business practices. In the years following the bankruptcy, Conseco underwent significant restructuring to stabilize its operations. The company operated under bankruptcy protection for several years and emerged in 2003 with a new focus on core competencies and a commitment to rebuilding trust with stakeholders. This restructuring phase was challenging, yet it enabled Conseco to rebuild its balance sheet and refocus on providing value through its core insurance products. While the company's reputation remained tarnished, it began to regain the confidence of the market through operational improvements and adherence to more conservative accounting practices. The legacy of Conseco's bankruptcy continues to influence corporate America today. It opened the floodgates for discussions around corporate governance and accountability in the financial sector, prompting regulatory bodies like the Securities and Exchange Commission to instigate reforms aimed at preventing similar failures in the future. Key takeaways from the Conseco debacle emphasize the importance of prudent risk management, financial transparency, and the need for strong ethical standards within corporate governance frameworks. It serves as a stark reminder that while growth and expansion are vital, they must be built on a foundation of solid financial principles to sustain long-term success.